Hello everyone, welcome to part 2 of our discussion of chapter 4. We're talking about things that reduce AGI, deductions for AGI if you will. And so you can find these on that schedule 1 or part 2, or I should say, schedule 1 for the 1040, part 2. The deduction for half of self-employment tax. So if you have self-employment income, and we will get into detail about that in chapter 6, okay, you pay a tax that replaces the idea of your Social Security that you have withheld if you're an employer. So if you're self-employed, you don't have an employer to withhold it, so you pay into the Social Security system equal to 15.3% of net earnings from self-employment. And net earnings from self-employment is after you take other deductions and after you multiply by 0.9235. And how to do that is shown in a video in our learning module below this one. And so you just want to go through, see how that is calculated. You calculate the net self-employment tax and the tax equal to 15.3. So this is filed, the Schedule SE is filed with 1040, but half of that, you pay the whole amount, but half of it reduces your AGI. Okay, so that you have to pay all of it, but you get to deduct half of it. So half of that is the same as 7.65% of your net earnings from self-employment is deductible for AGI on their 1040. Another one deduction available only for those who are self-employed. Okay, this is if they buy health insurance, so they don't have an employer that can subsidize the health insurance or provide group coverage, so they have to get their own health insurance, cover them and their family perhaps. Doesn't matter if it's all their family or just themselves. Okay, they get to deduct what they pay for that insurance, but it can't be more than what they make on that business. So in a year that, for instance, your business doesn't do well, then perhaps your income is low, you may actually pay more in as for insurance than you made in the business, and you could only deduct as much as you made in the business. Okay, so you can't have, you might say, a loss from that. And if your self-employment income for that business is 0 or less, or it's negative, then you don't get this deduction. Okay, and then the other limitation is, of course, if you have access to other insurance coverage. So for instance, if your spouse works at an employer that has coverage, then you have access to that. You are not eligible for the self-employment health insurance deduction. Okay, and that eligibility is determined month to month, meaning if you're, say, in 1 year your spouse was working for 6 months but then not for the other 6 months, then you would be ineligible for 6 months, assuming that the employer provided coverage, and you would be not eligible the months the spouse worked, and eligible the months that they didn't work, for instance, because then you wouldn't have access to the coverage. And then you would only be able to deduct the months that you paid in that you were eligible. All right. Usually not a very big amount, but penalty from early withdrawal of savings, it gets its own line on the Schedule 1. Okay, this only applies to accounts like CDs, where you put money in for a 3-year CD into the bank. They expect you to leave it in there for 3 years. You pull it out early, they're going to charge you a penalty. Okay? And it'll be reported to you on the 1099 INT. That's the same place that they're going to show you the interest you actually get paid for the CD. Okay? So put it on the Schedule 1. Usually not a big amount or anything like that. Much more important, for most in terms of amount, is alimony. Okay, that, and it's a little more complicated as to determining the amount that needs to be deducted and whether it's deductible. First of all, they changed the tax law, and so if your alimony starts, or your agreement between the ex-spouses starts in 2019 or later, okay, then this alimony is not deductible for AGI for the one that pays it, and is not included in income from the spouse that receives it. Okay, if you change the agreement after in 2019 or later, it also becomes non-deductible. But if you are still working with an agreement from before, back in 2017, 2018, previously, okay, and it hasn't been substantially changed, then it's still treated under the old law or the old rule, which is that it's deductible for AGI for the one that pays it, and it's income to the one that receives it. So, first of all, it has to fit the definition of alimony. 3 things that you can pay at a divorce. Typically, you have a property settlement where you divide up the assets. There's an order to pay certain amounts. Alimony is one amount, and child support is another one that could happen. Child support is not deductible and not included in income. Okay, has to be, only alimony has a tax consequence that affects AGI. It is for AGI or above the line for the paying spouse, if it qualifies as alimony. So how do we make sure that happen? How do we know if that's the case? Payment must be in cash. Okay. It must be required under the decree of divorce, meaning if I just give money to my ex-spouse that is not part of the agreement, I know it doesn't happen very often, but if that happens, it would not be alimony. It would not qualify under this alimony provision. And the payments have to be end of the payee spouse's death. So, it has to end with the death of the spouse. Otherwise, it's not alimony. So if you don't put that provision into the agreement, it's not alimony. Okay? The other thing that has to happen, you have to be, is separate child support from alimony. And remember that you may have an order in the divorce decree that says you have to pay, and it may say something like separate maintenance or use other terminology. If it looks like child support, the money you pay is going to first be allocated to child support, meaning child support is anything that is going to be based on the kids. So, for instance, if I was ordered to pay my ex-spouse $1,000 a month, as long as our children are under 18, the youngest is under 18, then it really is child support, because at the time they're 18, I don't have to pay the $1,000. If I pay $1,000 until they get to 18, and then I pay $600, then $400 is child support. Okay, and the other $600 could be alimony if it fits the other criteria. All right, so sometimes it's spelled out specifically, sometimes it just has different things like that, and we have to figure out how much is the child support and how much the alimony, because child support is not deductible, alimony is under these older agreements. The one that receives it has to include it in their tax return, okay? if alimony payments decrease sharply, a lot, $10,000 or more dollars, second or third year, the payments may be looked at as a property settlement instead of alimony, because alimony should be regular. It shouldn't be a lot and then drop off. That would seem to indicate that we're doing some type of property settlement. If it's something as a property settlement, it's not deductible for the payer spouse. Okay, and we may even have to go back if it looks like they paid $30,000 in alimony in year one after the divorce, only $10,000 in year two and year three. Then they can go back and say that doesn't look like alimony. Doesn't look like that $30,000 doesn't look like alimony. It looks more like a property settlement, and force them under review to reclassify that $30,000 if as non-deductible. Could be a problem and end up with some penalties going backwards that way. So alimony should be relatively the same over time and until situations in the spouse's life change, like someone gets remarried or whatever. All right, educator expenses. The thought is that many elementary K through 12 teachers pay for certain things out of their pocket for their classrooms because there's budget constraints at their schools. So they put this in. It's not a lot of money, but it can be kind of symbolic or helpful to an educator. Up to $300 can be spent, and as a 4 AGI, so above the line, you might say the double impact amount. And if you're both educators, it can be $600, but neither can deduct more than $300, so they both have to spend $300. That's not going to be hard to show, whether it was one spouse or the other, because most people have joint credit cards, all that kind of thing. So when they buy these things, it's going to pretty much be same receipts either way. What do you have to? How do you qualify for this? Pretty narrow, but it is a teacher, instructor, counselor, principal in K through 12. And they have to be basically not just part-time. So over 900 hours, which is a little more than half-time. And you can look that during the calendar year, the academic year, even though we file our tax returns on the calendar year. The deduction is for payments paid during the calendar year. What qualifies for things you could buy? Books, supplies, equipment. Okay, they expanded it during the pandemic. PP&E and disinfectant. I think most of those are being taken care of by schools now. All right, so that's the ones that we want to cover in Chapter 4, 4 AGI. There are some others, if you go back to Schedule 1, not the really minor ones down at the bottom, but others that will come up having to do with IRAs and things like that. And retirement plans. We will talk about those in detail in Chapter 11. So we'll hold off on that because there are some rules that are similar about all retirement plans that apply to IRAs. So we'll save that for later, but just know in the back of your head that there is a deduction for AGI for IRA contributions if done properly. And we'll talk about what that means properly and all that kind of stuff in Chapter 11.